Okay, turbulent times, as we know. What's our favourite phrase in the business breakfast at the moment? International headwinds. Yeah, they're a little bit strong, the headwinds. Probably gaining gale force at present, creating some rather choppy seas when it comes to the financial markets. No doubting that they are turbulent, that's for sure. But opportunity for us to look at where the smart money is going at the moment, and also look at some of the investment trends for institutional investors based here in the region and further afield. Who better to ask than the man behind the largest fund placement and investment advisory firm here in the GCC, an organisation that works with the largest sovereign wealth funds and institutional investors in the region. Someone with over nearly 40 years of experience in financial markets, with the last 11 years here in GCC. For those 11 years, he has set up and acts as the CEO of Greenstone Equity Partners. It is a warm welcome to Alex Gemici, who joins us live in studio. Alex, thanks for your time.
Thank you, Tom. Thank you for having me.
Am I over-dramatising it there? Turbulent times at the moment, or not?
Yes, very much so. Very, very much so. It's been a very interesting confluence of events. What has happened is multiple cycles in very rapid formation. We had a major stock run-up. We had a bear market, stocks coming down. We had commodities prices going up, commodities prices coming down. But the big picture is inflation. And the central bank's reaction to inflation. Inflation is new, hasn't been around for something like 42 years. And the central banks don't have great experience in dealing with it in the modern era. And the general way a central bank deals with inflation is they want to slow down the economic growth, slow down the economy, create unemployment, believe it or not, is one way to solve it. And to do that, they raise interest rates, which makes less capital available for companies to hire and invest and grow, which reduces employment, which reduces the demand in the marketplace, which therefore balances the supply-demand equation to a point where the prices are not rising.
So let's focus on the I word if we can. And as I said, and as you and I were just talking about off air, ain't your first rodeo. You've seen these turbulent times in the past during your illustrious career. Is there such a thing as an inflation-proof investment or not?
It is. Nobody really knows. There is no perfect solution to invest in an inflation-proof environment. Real estate is considered one that is one of the better bets, one of the better places to be. The idea is that real estate prices will increase with inflation at the rate of inflation or higher. That is more true on income-producing real estate because the landlords are able to raise rents on real estate, hence with inflation. The problem with commercial real estate is that there are 5-10-year leases where the rent is fixed for that period. The best real estate sector within real estate is apartments, where every 6 to 12 months, apartment rents come for renewal, and landlords historically have raised rents above the rate of inflation on residential apartments. So my recommendation would be as close to inflation as you can get would be investing into funds that invest in purchase and buy and operate multifamily residential apartment buildings.
Tom makes an interesting point, though. We spoke a lot about defensive stocks and those that were sort of bucking COVID trends during COVID. What else would count as a defensive stock in a time of inflation and possible recession?
The second rule about inflation-proof is companies that are capital light. And capital light's defined as companies that don't have large inventories, factories where when they have raw materials, they turn into products, large capital expenditures, the raw material prices go up and inflation, therefore their costs go up. So a capital light is tech. Any consumer tech company is a good bet because their costs do not rise anywhere near as proportionally as a capital-heavy company. Sure, the salaries do go up that they pay, but the salary cost to revenues is a very small ratio with tech companies. So I'd say capital light, I'd say tech stocks, of course the right tech stocks, is what I would recommend if you're looking for markets.
Is the smart money, and I know all money's smart, but not all money's smart, but is the smart money considered money going into tech at the moment, or is that too simplistic an approach?
We have seen movement into first alternative funds. Alternative funds are not traditional stocks and bonds, but more locked up hedge funds, private equity funds, venture capital funds. And real estate funds are considered alternative funds. And within alternatives, we've seen movement to venture capital, which is very much tech investments into tech companies, and also private equity, which invests, purchases, and acquires the larger companies, larger tech companies, and some into private debt. There is interest in yield, which is current quarterly payments on investments, even investments that are locked up 5-10 years. And there's been interest towards yielding investments to get current yield. That's more family offices and small institutional investors. The larger institutional investors are looking for opportunities, diving straight into venture capital, into private equity and private debt funds.
What does raising interest rates mean for all of this? It's going to get more expensive for businesses to borrow money and therefore expand.
Exactly. So the idea is you would like to bring down the increase in revenue for businesses so that they can hire less people and therefore there's less money for the economy. I mean, the solution to inflation, unfortunately, is increasing unemployment, and that's what is going to happen. What people don't really understand is it takes approximately 4 to 5 quarters for the effects of interest rate hikes to really reflect in the economy. So the pain is yet to come. The interest rate hikes have started a few quarters ago. They're going to continue going on. We're hearing that the best estimates are end of first quarter, middle of second quarter recession, true recession in the U.S. economy, which most economists that we trust and follow feel is inevitable. So they feel that there will definitely be a recession next year. It could be one where we come out of very quickly, because there's a lot of pent-up demand, and there are a lot of positive indications as well in what's going on.
Give us the positive stuff, Alex. Come on.
The positive indications is that there are substantial savings with households. Households saved, believe it or not, through the pandemic, $2.5 trillion. So households had $2.5 trillion more collectively in their bank accounts than after the pandemic, before the pandemic. They spent $500 billion already. There's an additional $2 trillion sitting with households that they did not have pre-pandemic. That is good dry powder, and that shows good prospects for growth. We do have to get past this inflation. And inflation was gasoline on fire, was really accelerated by the Ukraine situation, with the oil prices coming up, the supply chain disruptions. For example, we all talked about supply chain disruptions, which is how expensive it is to get the products from manufacturers to actual retailers. If you look at the cost to ship a container globally, historically, it's been about $3,700, 40-foot container. It was $7,800, more than double 6 months ago. And now it is, as of last week, it's actually below $3,400.
Alex, got to leave it there. Out of time on this occasion.
Of course.
Can't thank you enough.
Thank you.
Alex Gemici for joining us live in studio.